Imagine sitting across the table from a friend after a great dinner. The check arrives, and suddenly, they are fascinated by the ceiling. So you pull out your wallet. Again, they swear they'll pay you back, but as weeks turn into months, that money never moves. It is a stagnant debt. Within a friendship, this is a social friction. But when this dynamic scales up to a bank, it represents a functional break in the way money moves through the economy. To a bank, a loan isn't a favor, it is a profit-generating asset. The bank relies on the interest from that loan to stay in business. When a borrower stops making payments, that asset stops performing. It becomes a non-performing asset, or NPA. If enough of these loans stop performing, the bank's ability to provide credit to the rest of society begins to collapse. To understand the risk, we have to look past the individual dinner table and toward the bank's total ledger, where thousands of borrowers are defaulting at once. This pool represents every loan issued. Summing the defaulted debt gives you the gross NPA. This bad debt acts as a physical weight, trapping capital, causing cash flow to dry up. Without liquidity, the bank cannot fund daily activities or issue necessary new loans. A rising gross NPA indicates a bank is losing its primary engine of growth, as its own capital becomes locked in a cycle of non-payment. No bank expects every borrower to be perfect. They operate on the mathematical certainty that a percentage of people will always fail to pay. To survive this, they use a required defense called provisions. This is how it looks on the balance sheet. Every year, the bank must separate a portion of its profits and move them into a locked reserve. This regulatory requirement exists solely to absorb losses when a loan is declared unrecoverable. To determine if the bank is in danger, we compare the total bad debt to this safety net. Subtracting these provisions from the gross NPA calculates what they are truly at risk of losing. The figure that remains is the net NPA. While the gross NPA tracks the bank's total mistakes, the net NPA measures whether the bank has enough cash on hand to survive them. This is the figure regulators and investors prioritize when they examine a bank's financial stability. Gross NPA logs the history of bad lending, but it doesn't show how well the bank has prepared for those failures. The net NPA reveals the actual remaining vulnerability after all the bank's internal defenses have been applied. In the banking world, the lower the net NPA, the more resilient the institution is to a sudden economic shock. A high net NPA suggests a bank that failed to set aside enough profit to cover its own risks, leaving it exposed to a collapse. High-level finance often feels abstract, but it is ultimately just the math of human reliability. Those balance sheets are simply measuring how many friends the bank shouldn't have trusted, and whether it has enough money left in its own wallet to cover the bill.